What's up, everyone? Welcome back to the ETF Investor. I'm glad you're here because today we're breaking down one of the most important topics for building real wealth: how to use ETFs as part of a long-term investment strategy. Whether you're just opening your first brokerage account or you've been in the game for years, the principles we're covering today can genuinely move the needle on your financial future. Let's dive in. So, why are ETFs the vehicle of choice for long-term investors? Three big reasons. First, instant diversification. Buy one share of a broad market ETF, and you own a piece of hundreds or thousands of companies. That's risk management built right in. Second, rock bottom costs. We're talking expense ratios as low as 0.03% on some funds. Over a 30-year horizon, that fee difference versus actively managed funds can mean an extra six figures in your retirement account. That's not an exaggeration. Compound interest is powerful. Third, flexibility and transparency. ETFs trade throughout the day. You can see exactly what you own, and most brokers now offer commission-free trading. You can start with $100 or $100,000. Same strategy either way. Let's talk about building a core portfolio. The classic approach is a three-fund portfolio, and for good reason. It works. For your U.S. equity exposure, you've got excellent options. VTI from Vanguard gives you the total U.S. stock market, over 3,500 companies, for just 0.03%. If you prefer S&P 500 exposure, VOO and IVV are essentially identical funds from Vanguard and iShares, both at 0.03%. SPLG from State Street is another solid choice at the same cost. Any of these will serve you well as your domestic equity core. For international stocks, VXUS from Vanguard covers developed and emerging markets outside the U.S. at 0.08%. If you want to separate those, VEA handles developed markets and VWBO covers emerging markets. IXUS from iShares is comparable to VXUS if you prefer the iShares family. For bonds, BND from Vanguard gives you the total U.S. bond market at 0.03%. AGG from iShares is nearly identical. If you want to add some international bond exposure, BNDX pairs nicely with BND. That's it. 3 or 4 funds and you own a slice of the entire global economy. Now, let me show you exactly what this looks like in practice with 2 model portfolios you can use as a starting point. The first is what I call the simple 3-fund portfolio. This is perfect for beginners or anyone who wants a completely hands-off approach. You put 60% into VTI for total U.S. stock market exposure. You put 30% into VXUS for total international stock exposure. And you put 10% into BND for U.S. bond exposure. That's it. 3 funds, 3 tickers to remember, and you own over 10,000 stocks and bonds from around the world. Total cost is around 0.05% blended. A 25-year-old with a long time horizon might use this exact allocation. As you get older, you'd gradually shift more into BND, maybe moving to 50-30-20 by your 40s and 40-20-40 by your 60s. The second model is what I call the core and satellite portfolio. This is for investors who want a little more control and are comfortable with slightly more complexity. Your core makes up 80% of the portfolio. 50% goes into VOO for S&P 500 exposure, 20% into VXUs for international stocks, and 10% into BND for bonds. Then your satellite positions make up the remaining 20%. 10% into AVUV for small cap value exposure, which has historically outperformed large caps over long periods, and 10% into SCHD for quality dividend stocks that provide some income and tend to hold up better in down markets. This portfolio gives you broad market exposure at the core while tilting toward factors that research suggests can boost long-term returns. Total cost is still under 0.17% blended. Both of these portfolios will get the job done. The best one is whichever you'll actually stick with for decades. If you want simplicity, go with the 3-fund approach. If you like having a bit more control and don't mind a few extra holdings, The core and satellite model gives you that flexibility without overcomplicating things. How you split between stocks and bonds depends on your timeline and your stomach for volatility. A younger investor with 30 years to go might hold 90% stocks and 10% bonds. Someone approaching retirement might shift to 60-40 or even 50-50. There's no magic number. It's about what lets you sleep at night and stay invested through downturns. Within your stock allocation, a common split is 60 to 70% US and 30 to 40% international. US markets have outperformed recently, but that hasn't always been the case, and diversification means not betting everything on one country. Once a year, check your allocations and rebalance if they've drifted more than 5 percentage points. It takes 15 minutes and keeps your risk level where you want it. Here's the unglamorous truth. The hardest part of long-term investing isn't picking the right funds. It's doing nothing when the market drops 30% and every headline tells you the sky is falling. The investors who build real wealth are the ones who keep buying through bear markets, dollar cost average into your positions every paycheck, every month, whatever cadence works for you. Automate it if you can. Remove the temptation to time the market because almost nobody gets that right consistently. That's the playbook. Build a core with low-cost broad market ETFs like VTI, VXUS, and BND. Add satellite positions carefully if you want. Set your allocation, rebalance annually, and stay the course for decades. If you got value from this, smash that like button and subscribe to the ETF Investor for more breakdowns like this one. Drop your questions or your own favorite long-term ETFs in the comments. I read every single one. See you in the next video.